And now let me talk about risk. You just told me, you told me that they're not trying to make money, they're trying to get bought out. So if that's your business model, then do you think your company has systematic risk or idiosyncratic risk in terms of what investors care about? If your business model is to get bought out by a bigger fish, then I would think that your company, your prospects depends on the health of those bigger fish, right? If those bigger fish are kind of sickly and not very hungry, they're not going to be buying your company at big multiples. But if they are very fat and looking for new food, that's going to be very good for you. So what you just told me is something that took me 5 years to figure out, which is, why is it the case that a biotech company has absolutely no risk other than scientific risk? Why is it the case that it has such a high beta? And all of you just answered that question. It's because it's false to say that it's got no financial risk. It's got a lot of financial risk because that's the business model. You see, I, as a naive financial economist, thought that a biotech company should succeed or fail based upon its science, right? If your science is good and you've got good phase 2 results, you're home free, right? That's not true.
But the issue I take with that is that it's very expensive to fund a clinical trial.
Right.
If you could acquire the capital to get through phase 3 and get an approval,
right,
you might actually be making a ton of money. So
right,
how do you reconcile that?
That's exactly the insight. It's that the risk of a biotech company, there's scientific risk for sure, but on top of the scientific risk, there's financing risk. There's the risk of running out of cash. You agree, I think what you're saying is that if you have no financing risk, if you had all the money in the world, then the only risk that's left is scientific risk. And that scientific risk has nothing to do with whether stock markets are up or down, right?
Yeah.
Yeah.
I just, I don't buy it that all biotech just wants to get bought out. I don't think that's the goal.
They don't, but they do want to be able to move their products ahead, so they need to do that by some source of financing. So it could be done by partnering, it could be done by lots.
I understand that, but
you need money. You need money.
You need money, but I think it's kind of oversimplifying to say that biotech just wants to get bought out by big pharma.
Okay, I agreed. I did that to emphasize the point, but let me be more precise. In order for biotech to survive, they need some kind of cash infusion to move products along, right? And most often that happens when they get bought out, but you're right, they could do a licensing deal, they can do some kind of partnerships, they can be partially acquired, but they need to raise money. And how do they do that? They raise money from capital markets, meaning either the stock market or a big pharma player or venture capital or some source of funding. Typically, venture capital doesn't get involved in the late stage stuff. So it's going to be private equity or pharma or some other source. That's the risk. It's the risk that you can't get the money when you need it. Now, let me ask you, if you don't get the money when you need it, is that really a big problem? I mean, why not just, put the asset on the shelf for a few years and then take it down when you do have the money? What's the big deal? Is that easy or hard to do? Why is that hard to do?
Because the science moves, they need it.
The science moves, people move. And we know that this is a pretty people-intensive business, right? So when a project fails because you can't get the funding, it stops, and then the knowledge moves and leaves. And you may be able to get it back in a part way, but it's not easy. Mariana?
So I understand that they will need the funding and then they can move on, but there's many of the pharma, the biotech that end up failing. That's why the farmers or the VCs or the equities are hesitant in putting money. So it's kind of a catch-22.
It is. And that catch-22, another way of saying it, is that it actually magnifies the risk. And that's the risk that we're seeing. So this is the CAPM betas of pharma companies and biotech companies. And it proves what we all have been saying, which is that biotech companies have higher systematic risk, which to me was totally counterintuitive until I actually learned a little bit about how a biotech company survives and moves things forward. It's a really tough challenge because what it requires is not just money, but exquisite timing. You don't just need money, you need money at a very specific point in time. There is a window when you need the money. If that money comes 3 years later, that doesn't help. If it comes 2 years earlier, that actually doesn't help. You need it when you need it. And that's the risk that we're seeing with these betas. So with higher betas, it means higher cost of capital. With higher cost of capital, it means higher threshold for projects. And with higher threshold for projects, it means you're going to be taking on fewer projects. And therein lies the valley of death. So if there is a valley of death, and I believe there is, and those of you who are in the industry, you can confirm if that's the case or not, this is one of the big reasons for the valley of death. It's that there's tremendous financing risk. And to Mariana's point, if a venture capitalist is worried about an investment needing mezzanine financing 3 years from now, and there might be a potential crisis at that point, the VC won't invest today just because they know that 2 or 3 years from now, there's no exit and it won't move forward. Even if they're willing to hold it for 5 years, if the project stops in year 3, that's it, end of story. It's very, very difficult to take a project, transfer it to another organization. That's one of the reasons why pharma companies are so important. They play that role of buying compounds that have failed and moving them forward. So if there were a more active market, you would see less of this. And in certain cases, there are. When are there active markets for these compounds? When would you expect that pharma would be wheeling and dealing and being able to buy and sell these things? Under what kind of economic conditions? When the market is doing well, right? Exactly, when they're doing well. And that's beta. I just described to you a beta, right? So we are now at a point where we see that volatility also plays a role. Biotech has much higher volatility than pharma. Pharma's volatility is about the same as the market. So big pharma really behaves like a stock market type of investment. Biotech is much riskier. It's got higher total risk, it's got higher systematic risk, higher beta, and for those reasons, you're going to have a much harder time financing these companies. They're going to come in waves. And the wave of big biotech financings has been waning. It might continue for a little while longer, but as of last year, there were some real difficulties so that the number of IPOs has declined. And I suspect this year it might be the same or less. But a couple of years before that, it was fantastic. So there are windows of opportunity, and these cycles of feast or famine is really what characterizes the industry. And you can see the volatility cycles of biotech as well as pharma, but there are a lot more cycles in biotech. And this just does variance decomposition to show how much is idiosyncratic, how much is systematic. Biotech does seem to have higher amounts of systematic risk than pharma, not surprisingly for the reasons that we just said.